Cascading effect. Cascading effect means tax over the tax. How the tax will be imposed on the tax. To understand this, I will tell an example so that you can understand the cascading effect with the most clarity. Consider A as a tire manufacturer. For manufacturing the tire, he needs the raw rubber for worth of 100 rupees. He is getting 100 rupees worth raw rubber from the rubber producer. And for the sake of simplicity, you keep the taxation as a 10% uniformly. When the A is getting raw rubber, he will be paying the amount, once again, he will be paying the amount worth 100 rupees plus tax 10%. Therefore, 110 rupees he will be paying. And this tire manufacturer will do certain processing or value addition to this rubber and convert this rubber into the tire. And for this value addition, he will be requiring 20 rupees. And when he is about to sell the tire to the car manufacturer, that is B, he will be quoting the selling price as 130 rupees because 110 he already paid, 20 rupees is a value addition. And B will be buying this tire by paying 130 rupees plus 10% tax, which will be summing up to 143 rupees. If you are looking this transaction carefully, you will be seeing one tax has been taxed again. How? A already paid the 10 rupees tax to the rubber producer, but that 10 rupees, it has been included in the selling price to 130 rupees. So when the B is paying the tax for 130, already the tax 10 rupees is part of the 130. Again, it will be paying tax for this 10 rupees. Correct. In the car manufacturer B is selling this car to some other person, means again it will be including 13 rupees tax which it paid in its selling price. Therefore, this 13 rupees or the 10 rupees is going to get taxed again. By the subsequent taxation, what is going to happen means the burden of taxation is going to lie with the end consumer, and the end consumer end up paying huge amount because of the lethargy of the system. To overcome this double taxation or double counting of the taxation, government introduced a concept known as the input tax credit. What is this input tax credit? I will tell you with an example. Take the same example. A is getting 100 rupees worth rubber from the rubber producer and it is paying 110 rupees. Correct. And when this A is doing certain value addition of 20 rupees. Now, when the A is selling the product to the B, how much when it is about to sell, government is instructing the A that don't add whatever tax you paid in the selling price. Then A will be telling, if I'm not adding this 10 rupees in the selling price, means how I will get the 10 rupees back. It will become a loss to me. For this, government is telling, wait and behave as I'm telling. So B will be paying how much? A will be quoting 120 rupees because this 10 rupees is a tax. A will be quoting the raw material cost and the value addition price 20 rupees like this. And B will be paying 120 rupees plus 10% tax. Therefore, 132 it will be paying. So in this transaction, government is telling to A that you are collecting 12 rupees as a tax from the B. Correct. In this 12 rupees, you withhold 10 rupees, whichever you paid in the previous transaction to the rubber manufacturer, and transfer the remaining 2 rupees to the government. So in this transaction, government is also facing 2 rupees profit and A is also getting back as tax. By this way, it has been charging only 132 rupees. In a previous case, it has been charging 143 rupees. Because of leaving the taxation, the amount has been reduced. Therefore, consumer will be happy and everybody will be having the profit. What is the input tax as a definition means? Input tax is nothing but if a manufacturer is here means whatever raw materials he is getting, for that input, if he is paying certain tax means that is known as the input tax. And when he is processing this input and making this as an output, at that time, whatever input tax he is paid, he is having liability to take or to withhold whatever tax he is getting from the output tax. That is, in this case, if A is the tire manufacturer, he is paying 10 rupees for the input because raw rubber is the input for the processing. For this, he is paying 10 rupees as an input tax. Whatever he paid as an input tax, he is having credit or he is having liability to collect this 10 rupees back during the subsequent transaction. That has been happened here. When he is selling this to the B, when the B is paying the tax, he is taking back his 10 rupees tax and he is giving the 2 rupees back to the government. So this is the concept of input tax, and whatever tax he is paying, it will be acting as a credit. Credit means he can get this 10 rupees back in a subsequent transaction. So this is the concept of ITC. And this ITC as a concept introduced before the GST, even in the VAT. VAT is a taxation regime before the GST. This ITC has been introduced in the VAT too, VAT itself. But in spite of introduction, VAT can't eliminate this cascading effect completely because of some difficulties with the VAT. What are those difficulties in the VAT? We will see in a separate video. I hope the concept of cascading effect and ITC is clear to you. And GST eliminated this cascading effect by introducing the ITC. I hope the concept is clear to you. If you like this initiative, please like and subscribe this initiative and share this initiative. If you are having any comments or queries, please let us know your queries or suggestions. Thanks for being with me. Have a great day.